Hello everyone, this is Orhan. In this video, I will continue our discussion about the risks associated with bonds. Let's start with the default risk. Default risk is the probability that a borrower fails to make full and timely payments of principal and interest. If the issuer defaults, the investors will receive less than the promised return. Recall from the previous chapter that the quoted interest rate includes a default risk premium. DRP stands for default risk premium. The higher the probability of default, the higher the premium, and thus the higher the yield to maturity. In other words, the higher the default risk premium for a company, the higher the yield they should offer to investors. Since the early 1900s, the default probability of companies are evaluated by rating agencies. There are three major rating agencies in the United States: Standard & Poor's, Fitch, and Moody's. Different rating agencies have different letter scales. For example, in this chart, you see S&P and Moody's. They all start with AAA. The triple and AA bonds are assumed to be extremely safe. Single A and AAA bonds are also strong enough to be called investment grade bonds. These are investment grade bonds. Double B and lower bonds are speculative or junk bonds, and they have a significant probability of going into default. These are junk bonds. So the other name of junk bonds are high yield bonds, just because they should offer high yields to investors. Otherwise, nobody would buy them because they are extremely risky. So ratings are tied to bond yields. The higher the rating, the lower the yield. Bond ratings serve to relieve individual investors of the time and cost of a detailed credit analysis of their own, but please keep in mind that rating agencies do make mistakes, and bond ratings only measure of an issue's default risk, which is not related at all to an issue's exposure to interest rate risk. We can also check the details of rating agencies' letter grades from Bloomberg screens. RATD serves for this purpose. When you click TD, you will see the details of all rating agencies in the world. As you can see, there are more than three, but the three are the major ones. So when you click on, for example, Standard & Poor's, S&P, you can see a couple of letter grade scales they offer to investors. Let's take a look at the first one. So it starts with AAA, and then you have the detailed explanation of what it means. For example, AAA is the highest rating assigned by S&P. The obligor's capacity to meet its financial commitment on the obligation is extremely strong. Credit rating agencies do make mistakes, and they did a lot, especially before 2008 crisis. Let me show you one example. This is Bank of America's credit rating history. Let's take a look at Moody's credit ratings. So this is the history. Let's scroll all the way down to 2007 and 2008. This is 2008 credit rating of Bank of America. This is Moody's credit rating scale. As you can see, AA1 is the second highest grade given to a company. So Bank of America had an AA1 before 2008 crisis, which means that it's very low probability to default. But Bank of America Corporation was rescued by US government on Friday through a $20 billion bailout and a guarantee for almost $100 billion of potential losses on toxic assets. And so rating agencies make mistakes, and they did a lot before 2008 crisis. That was my point. The next risk we are going to talk about is called the price risk. I'm going to explain the price risk using an example. In this example, I have two bonds. The first one is a 1-year bond, and second one is a 10-year bond. Both of these bonds, they offer 10% coupon. The par value is $1,000 in both cases, and yield to maturity is 10%. The only difference is one is 1-year bond, second is 10-year bond. That's the only difference. Now let's go ahead and calculate their prices using PV function. PV 10%, comma 1, comma coupon $100, and then par value. When you hit enter, you'll get the price of this bond. And do the same thing for the second one, 10-year bond. You'll get the same price, just because they offer the same interest rate with under the same yield to maturity. Price of both bonds is $1,000. Now let's change yield to maturity, and let's see what happens to their prices. In the first case, I'm going to change yield to maturity to 5%, which I will call scenario 1. This is scenario 1. In the second case, I will change the yield to maturity to 15%, which I will call scenario 2. Okay, now let's take a look at scenario 1 and change the yield to maturity to 5%. The only thing I change in these functions is this 5%. So instead of 10%, I'm going to use 5% here. Now let's click on this cell and delete this question mark and hit enter, and let's see what happens. As you can see, when yield to maturity went down, which is what we expect, the prices went up. Okay, so both of these prices increased from $1,000 to something above $1,000. But please pay attention that 1-year bond increased by $47, but 10-year bond increased by $386. Okay, now let's do the same thing with an increasing yield to maturity. So I'm going to increase the yield to maturity from 10% to 15%. Now let's click the cell and then delete these question marks. Okay, what we expect is that the prices should decrease. Okay, so they both decrease, but again, this one decreased a little, but 10-year bond decreased more than 1-year bond. So once again, when yield to maturity goes up, the prices goes down. When yield to maturity goes down, the prices goes up. What we call price risk is that 10-year bonds price change is much higher than 1-year bonds price change. We can show this using a graph. Let's review the change in percentages. When the yield to maturity went down from 10% to 5%, the price of the 1-year bond increased by 4.8%, but the price of 10-year bond increased by 38.6%. When yield to maturity went up, both prices went down, but the price of 1-year bond went down by 4.4%, but price of 10-year bond went down by almost 25%. This graph also illustrates that point. When yield to maturity increased, the price of 1-year bond decreased by this much, but the price of 10-year bond increased by that much. That's the same thing when yield to maturity decreases. The price of 1-year bond increased this much, but price of 10-year bond increased that much. Okay, this was all about the risks. Let's talk about a couple of different types of bonds. The first one is Treasury Inflation Protected Securities, which we call TIPS. These securities offer investors the opportunity to stay ahead of inflation by periodically adjusting their returns for any inflation that has occurred. In other words, they kind of protect you from changing inflation rate. There are also municipal bonds. Municipal bonds are issued by states, counties, cities, and other political divisions. The good part of municipal bonds is that interest can be tax exempt from state and local taxes if you live in the state where the bonds was issued. There are also zero coupon bonds. Zero coupon bonds do not pay any interest, so it's 1-period bonds. Assume this is a 1-period bond. You buy the bond at time 0 and the bond matures at time 1. So there's no coupon in between. You pay the price here and there's par value here. Say, for example, you buy the bond for $90 and they promise you to pay $100 at the end. So you make an interest of $10 as an example. One last type of bonds I should mention is called mortgage-backed bonds or mortgage-backed securities. Let me explain this using an example. Assume John wants to buy a house of $100,000. Assume again, for the sake of simplicity, that the bank lends $100,000 to John, so 100% of the house value. Lending $100,000 to thousands of investors might make the bank a little short of money. That's why a bank, together with a financial institution, here, and the kind of issues a bond called mortgage-backed security and sells these securities to investors. And there are 4 investors around. Each investor buys $25,000 worth of these bonds. They are kind of financing John. So these $25,000 each makes $100,000. So they get this mortgage-backed security from the bank and in return pay the money, get the security, pay the money. Get the security, pay the money. Why do these investors buy these mortgage-backed securities? Just because every single month, John is assumed to make monthly payments. So assume again that these monthly payments is $500. So these $500 goes to bank, and bank, together with financial institution, transfers this $500 these 4 investors as $125. So every single month, these investors receive $125 in return for their purchase of mortgage-backed security. So they get this $125 every single month throughout the term of the loan. This is more or less what mortgage-backed security is. This wraps up our discussion about the risks associated with bonds and different types of bonds. I hope you enjoyed the video. Hope to see you in the next videos.